Hello, mates of Equity Mates. Or I guess that just makes you Equity Mates. Anyway, it's Bryce here. One of the most frequently asked questions we get is, where do we find information about all these stocks and where's a good place to start? Now, we could do a whole episode on this, and we often do touch on it, but the best place to start is by signing up to our Thought Starters weekly email. Each week, we send you some cool stuff that has caught our eye during the week, as well as some more detailed articles on stocks and invested-relating content. We also include Basics 101. These are articles tailored specifically for beginners to really propel you on your way. We don't spam you. We hate spam. It's once a week and there's enough stuff in there to occupy you for a full day of browsing at work. Now, Ren puts a lot of effort into finding quality articles for you guys, so if anything, just sign up so he feels the love. Head to equitymates.com and chuck in your email at the bottom of the page.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, where we help you learn to invest in 15 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. How are you?
Good. Always good. So, we've had part one of Andrew Brown, where we looked at some of the stocks that he recommended to us last time he was on the show, and we looked at how he keeps on top of his information flow, which was a fascinating interview for us. We both got some great stuff out of it, and we hope the listeners did too. If you haven't listened to it, definitely go back and listen to it, because it's a great lead into this one. So what we wanted to do with Andrew, and it's something that we haven't done with any of the expert investors that we speak to, but we wanted to delve specifically into how he actually analyzes a stock. What is it that he looks for in stocks when it comes to him trying to determine if he wants to buy or not? So we let Andrew choose the stock, and we said, look, these are the parameters. We want to understand from beginning to end what you're looking for, and can you explain to us why you have chosen this stock? Ren?
Yes. So the stock that Andrew chose was Cabcharge, ASX code CAB. He will do a bit of explaining about what Cabcharge is and what business they are in. It's in the name, really, but he'll do some explaining in the episode. But yeah, look, this was a great one for me. This is something that I really want to understand through this podcast and speaking to our guests, how they identify potential stocks, what their process is from there, how they value it, and then what they do once they've purchased the stock, how they maintain information flow, how they continue to make decisions. And so these were the questions that we got to ask him. So I felt pretty lucky that he gave us his time and we got to learn a lot.
Absolutely. It was a great insight into the way that he was thinking. So yeah, I had a great time with him as well. Apologies going forward for any of the sound recording that we've got at the end. Halfway through, the cleaner of his office decided to switch on the vacuum, so there might be a bit at the end, but bear with us. It doesn't last too long.
Hopefully at this point we've found a way to edit it out, and you guys are confused by this part of the intro, but if not, we apologise.
Yeah. Enjoy.
Okay, so that was
an intro to an intro.
Yeah. But no, I think that was a good summary of some of the main concepts that now we're going to sort of apply to your process.
Absolutely.
So maybe we'll introduce the company that we're going to sort of use as an example throughout this process.
Yeah.
And that is a company that we spoke about in our last episode. And you took particular pride in lording it over one of our podcast rivals, over Motley Fool. And that company was Cabcharge.
That's right. So when I look at Cabcharge, I think the stock was in the high twos when we spoke last time. The stock currently is just above $2. So you might think, well, that's pretty terrible. What you need to remember is, in the meantime, I've had $1.04 of fully franked dividends out of Cabcharge. So we haven't, in a total return sense, we haven't made a lot. Of course, a lot of my returns come from the franking credits, which may or may not be refundable in cash in the future, depending on which government gets in after the next election. So from an after-tax point of view, it's actually been not a bad investment at all.
The price did get up to about $4 at one
Yes,
point.
it did. That preceded those dividends being given out.
Yeah.
Okay, what happened with Cabcharge is it sold a couple of assets, which we're going to talk about, and ended up with too much cash, and so it paid out 80 cents a share fully franked dividend.
Wow.
So, I guess the question is, you identified Cabcharge, but
Yes.
let's start from the start.
Yeah.
Why Cabcharge? How did it come across
Yep.
your desk?
Yep.
And what made you what piqued your interest?
Okay. It's probably worthwhile explaining what Cabcharge is. Okay. It basically is the taxi industry and all its guises. First of all, it's the charging system for cabs. So if you pay by credit card, it is the major but not the only payment system. And they take a fee off your credit card for using their payment system. That fee has come down. We'll talk about that in a minute. Secondly, Cabcharge is the largest owner of cab licence plates in New South Wales. So it owns taxi plates. And it's also a big owner in Victoria, a big owner now in South Australia and also in Queensland and elsewhere. So it's, in totality, it's the largest owner of taxi plates in Australia. So if you want to drive taxis and you need to lease a taxi, they're your best bet through them. They're most best known in Sydney as Taxis Combined, who now changed their name to 1-3 Cabs. And I'll come on to why again in a minute. The third thing about Cabcharge is they are the biggest provider of effectively messaging services in the taxi industry. So if you're going to buzz to get a job, okay, they're obviously because they owned the old Taxis Combined as a fleet, so they're like a fleet manager and obviously hand out jobs, okay, and regulate those jobs, and obviously increasingly that's been done through apps. Rather than just ringing up and speaking to someone. In addition to that, they did have, until last year, some investments in a bus company. You would know them as Hills buses here. They're actually called CDC Delgro, and they ran particularly school routes in various parts of Sydney, most notably up to the northwest. And they also had some investments in taxi fleets and services in the UK. Notably in Aberdeen, Birmingham, and a little bit in London. Okay, so they had everything else to do with cabs. They also had quite a big property portfolio. So if it's to do with cabs, Cabcharge had its finger in the pie, categorically. So, why were they interesting? Well, first of all, if you're a value investor, just my description of them, you'd probably start thinking two words, which is treasure trove. There's a lot of goodies in there. The second thing is the share price had collapsed from $10 to $2. Why was that? That was largely due to two components of regulatory change. The first was that the fee they were allowed to charge for debiting your credit card used to be 10% everywhere in Australia, and basically it was regulated down to 5%. That happened quite gradually because it's done on a state-by-state basis, not on an Australia-wide basis. So in fact, the last one only came into play in the first half of this financial year. The second regulatory baseball bat, of course, was wielded by those American loss-making students called Uber. Okay, and Uber effectively was, for a while, outlawed in certain bits of Australia, most notably Victoria. But, and as has happened pretty much around the world, Uber's gradually got traction and has been legalised in some form or other. And that's enabled potentially other ride hire services to come into the market as well. But Uber is the main one. So, that's why the share price collapsed. Because basically a lot of people said this is the best short on the market, it is going to go out of business. And if you look at some other companies around the world, particularly companies that finance taxi medallions in New York, they're really struggling to stay afloat, because the taxi business obviously has been belted around by Uber. And you've got to remember, Uber makes no money. Uber loses billions of dollars a year, and that can only go on for so long. Okay? So I was interested because Cabcharge was still making a profit. So some of the ratios I'm going to talk about a little bit later on look very, very cheap to me. And so I started to do some homework on whether Cabcharge was just going to go out of business. Okay, gradually, slowly, death by 1,000 cuts, but gradually go out of business. And I came to the conclusion after doing a various amount of research that the answer to that was no. Okay, and maybe dig into the kind of research I did. Okay, the first bit of real hard-nosed research I did was I drove Uber for 3 months.
Really?
Okay. Now the reason I did that, it's all very well being an Uber customer. Okay. We all know Uber is undercut taxis and you can ride cheaply. So if you don't do the other side of the equation, you just sit there and you think Cabcharge going out of business because it's just you're getting discounted rides and you don't care.
Yeah.
Okay. You soon care when it starts raining, by the way, because of course Uber suddenly costs more than a cab when it starts getting 2 times, 3 times surge. I wanted to see what it's like from an Uber driver's point of view, because if Uber drivers make no money, then Uber can't exist.
Yeah.
Because it becomes effectively slave labour. Now, in the United States, that is very different to Australia. We have a much bigger adherence in Australia to basically regulated wage rates, minimum wages, and things like that. And so people don't like wage systems which basically condemn them to earning significantly less than the minimum wage. I acknowledge that there are people in Australia who are quite happy to earn less than the minimum wage, and they have been exploited quite badly by some publicly listed companies. Okay, some in the franchise industry, where effectively the franchisees only make money if they underpay the staff. They can't possibly make any money because of the ridiculous cost of goods and the ridiculous cost of rent and everything else. So I wanted to see, is Uber just another version of that? And the conclusion I came to was that I did it very early on in the piece, but the conclusion I came to is that it was quite clear if you drove Uber for full time, you're not going to earn minimum wage. Okay, and you're certainly not going to earn minimum wage when you took into account the proper accounting of your time and your costs. Okay, and your costs, of course, are petrol. I can guarantee that you have a much bigger chance of copying traffic fines and points. And of course, the other thing is that you're wearing your car out at a much bigger rate of knots. Because if, like me, you drive in Sydney, you're not driving long distances, along motorways. You'll basically stop, start, traffic lights, traffic jams, and everything else. So I could make $1 out of it. There's no question about that at all. But I rapidly came to the conclusion that pre-depreciation petrol, but after petrol, you're probably getting about $20 an hour. So once I reached the conclusion that it was basically about $20 an hour, I came to the conclusion that cab driving, rather than Uber driving, was actually probably still pretty attractive. And that there'd be people who enjoy that sort of stuff or need to do that, who would be a lot happier being a cab driver. But they're only going to be happy being a cab driver if one or two things happen. First of all, could they do cabs and Uber together? Yes, you can. As you know, you can book an Uber, sort of an Uber cab, which is actually a taxi booked through Uber. Secondly, was the people that operated the taxi industry going to get their proverbial together? Because there have been a number of years where the industry had been underinvested in because it was a great cash cow. Okay? And that's what gave Uber a particular opportunity in Australia and in Sydney in particular. And so I started doing homework on Cabcharge, the company itself. Started to interact with the management, just through webcasts and things like that, and started to realise there'd been an absolute sea change in the management of the company. Okay, where they realised that they let down the customers and they let down the drivers. Okay, and you got to the stage, the old smelly cab idea, that basically cabs were dirty, expensive, whatever. And of course, they were hard to book. When Uber, you just went on your own. So, of course, what's happened since? Well, Cabcharge have completely revamped their business. 1-3 cabs, it's an app. Is it as good as Uber? Not quite. Is it really as good? Absolutely. You can contact the driver who's coming to pick you up. You know what his or her name is. You know where they are. So you can get in touch with them and say, hey, you should turn right, not left, when they're coming to your house or unit block to pick you up. The cabs are much cleaner, the drivers have got better uniforms, they've got better technology. So they're happier. And they're earning better rates than they would earn if they were driving Uber alone, because, of course, the higher cost of a cab is obviously greater. And they tend to have greater knowledge of the roads and everything else. Not always they acknowledge, but, in general, the service should be better. Okay? So that I started to realise that Cabcharge still had a role to play. Cab still had a role to play. And then there are other little idiosyncrasies that have said when it rains, cabs are cheaper than Uber on time. Okay?
I would agree that they're cheaper at most parts of the night as well. Like,
yeah.
It's for shorter distances. I'm not so sure about longer distances, but for shorter distances in the city, I mean, we have no qualms getting a cab just because they're quite comparable with Uber.
That's right. I mean, what's going on, particularly with smart young people, is, of course, they arbitrage cabs versus Uber versus any other ride share that's out there. Okay? And the big thing is, don't forget, ride shares don't work unless you've got a lot of cars on the road. So I'd argue in cities like Sydney, unless somebody just floods a particular part of Sydney, say like outer western Sydney with cars, it's pretty hard for other rideshare services to get up. Okay? So we've got lots of Ubers already, it's well known and ubiquitous, and we've got lots of cabs already, and they're dominated by 1-3 cabs. Okay? So I did homework like that. And that's really important because in this particular business, there's no real-time statistics. Okay? If you're analysing a bank, you've got credit growth numbers that come out every month from the Reserve Bank and the Australian Bureau of Statistics. If you invest in a building materials business, you get building statistics come out every month. So you know that in certain parts of Australia, there's a lot of building going on, in other parts maybe not. You know what type of building it is. Okay? So you can start to form an economic viewpoint, if you will, that that industry is going well or it's not going so well. Okay, and react to that, as well as the company intelligence that you get from, from listening to company webcasts or participating in if you're a professional. Okay, in the cab industry, there's nothing. There are statistics, but they come out like about a year and a half after the year that they're finished. They're pretty hopeless in terms of industry stats, except from one source, which is Cabcharge. So all you can do it's kind of like the wet finger test. So jump in a cab, what do? Talk to the cab driver. How's business, mate? Oh, it's terrible. It's great. Or whatever. I mean, it's just the whole thing of speaking to people and understanding, because there's no industry stats. Okay, so that can be a bit hard, and that's why I went and did it for myself, and actually work with them to understand completely and utterly the economics of how the threat to Cabcharge worked. Okay, so quite important.
So maybe just to recap. So at this point, you were driven Uber for 3 months. You had realised that the value proposition for Uber drivers wasn't quite there.
Yes.
And that the cost, when the surge pricing was comparable or cabs were better. So you realised there was probably more competition than the market thought there would be in that industry.
Absolutely.
But then where did you go from there to decide that Cabcharge as a business is a worthwhile investment?
What was really critical, as I said, is there was a management change about 3 years ago, and that caused Cabcharge, as I said, to reinvent itself. And what Cabcharge has basically reinvented itself as is basically a personal transport company. Okay? And so obviously that means a value proposition, so service versus price and everything else. But what started to become very clear, and to be fair, this is Cabcharge statistics because they're the main player, there's no other listed player. But what's quite clear is that there is growth in personal transport. People are using a lot more personal transport these days, and there is growth. It's just that, of course, that growth's been split between a lot more players than it used to. Okay, because we've got Uber. So Uber's grown the market. So guess what? It's grown the market for Cabcharge as well, believe it or not, because people are used to actually saying, I won't get a bus. Although in Sydney, public transport is booming, so people are obviously leaving their cars now. in a much, much bigger way. Just think it through. So start to look at the statistics of that, which are largely from Cabcharge, Cabcharge provided stuff. And I started to look at the way the company was reinventing itself in the service bit to say, yes, they have a future that way. Okay? And it was quite clear I wanted to see they had technology and that they were investing in technology, and I was probing in terms of how much they were investing. And starting to see, obviously on my own phone, that, hey, well, this app's actually okay, and then it gets better and better and better and better. So I started to look at those kind of things as well, as well as starting to get into the numbers, okay? Because obviously, if you've got a business like Cabcharge that's threatened long term, and this is not a risk-free investment quite clearly, it's just a very cheap one, as I'll tell you in a minute, then you need the numbers to really stack up. If Cabcharge had a lot of debt, you wouldn't go near it. Okay? Because you're going to discover Cabcharge is not a lot of debt. Okay? So the critical thing is basically, if this company was going to go broke, it was going to go broke real slow.
Yeah.
Okay? So it's going to give me a chance to say, the thesis has changed. I think I'm wrong. Clearly I was going to lose some money, but I wasn't going to shoot myself.
Yeah.
I wasn't going to lose it all.
Yeah.
Okay? Because it was going to go, as I say, it's going to die pretty slowly in my opinion. Okay? So, that was a really critical thing. So then we get to the sort of the nitty-gritty of the numbers, okay? Of why did this thing, given all that we've said, okay, why did it actually start to stand out and appeal? And it doesn't matter what sort of investor you are, there's one thing above anything else that is very, very appealing, and that's just cash. Okay, or cash flow. Okay. So when I started to look, when I looked at this company, it had a lot of spare assets on the balance sheet. Okay. As I said, it was a bit of a treasure trove. So first of all, it had the bus company. It owned 49% of the bus company. Okay. And it also owned 49% of this thing in the UK called City Fleet. And its joint venture partner was Delgro, which is a listed company in Singapore. Okay, so, we have a cross-check already. What are they carrying this stuff at? What's their carrying value for these things? Well, they're actually consolidating their accounts, which you can see their commentary about and everything else. Because it became abundantly clear that these were non-core assets to Cabcharge if they're reinventing themselves as personal transport in Australia. All right? However, there was a problem because they were carrying on the balance sheet a value of $297 million. And to give you an idea, that was 20 times the after-tax earnings that they were getting out of these things. Right, okay. Now, to give you an idea, at the same period of time, the stock market's overall multiple of after-tax earnings. So it's equity, 300,000 of our house, divided by our after-tax return, was about 15 to 16 times. And these things were not growing.
Yeah.
Okay. So it was obvious to me that they were blatantly overvalued on the balance sheet, and I was going to have to make an adjustment to what I thought they would get for them when they were sold. And I made somewhere in the order of an $80 to $90 million adjustment.
Wow.
Okay, to that when I started to value Cabcharge. And as if by magic, last financial year they sold both of these things, and their total write-down was about $94 million.
Oh, wow.
Okay. I also don't mind telling you I was particularly vociferous at the annual general meeting. Explained and asked direct questions of the auditor, which you are allowed to do.
Okay.
As to how come they hadn't picked this up the year before and everything else. Because I'd made the point at the prior annual general meeting that if I could short sell their investments in these things, I categorically would. So that's absolutely right. Now that's a really big thing because it's a great thing if you've got a company that's needing to turn around, or you've got a company that isn't going particularly well, but may start. You want to see them get rid of non-core assets. Okay, liquidate those non-core assets and use the money to either repay debt or in the case of Cabcharge, reward shareholders. Because they got over $200 million for this stuff. And they've got 120 million shares on issue. So they repaid all their debt, had net cash, and had too much net cash. So that's why they were able to pay out these very large dividends last year. Okay? So that was the first thing. Is once I knew that they were kind of really thinking about selling the assets, that was really, really good. Okay? Now, the second bit of it is that's all very well. It's no good them selling assets and paying a big dividend if the rest of the business is not going particularly well. And their EBITDA was going down, okay? And it was largely going down because, of course, of these caps on the amount of money they could charge on credit card fees. The good thing about Cabcharge is its disclosure in its accounts is really good. They segment out their revenue in quite a granular fashion as to how much they get effectively from, I'm going to call it credit card fees, how much they get from a taxi servicing network, in other words, how much they get for leasing out plates, how much they get for buying and selling plates and brokering plates and things like that. So it's actually really good. So you can sort of work out in broad terms what profits they get from each bit of the business. And obviously, profits from brokering plates, well, then, it's not a great business really. It's okay, it sort of pays the rent. Okay? Whereas what you really want is you want the profit out of the Cabcharge bit itself and the profits out of basically leasing cabs to people to drive. That's the more valuable bit of the business. So I started to do a lot more homework on breaking that down. Okay? The third thing with Cabcharge is the one thing about it that is really, really appealing about it is got a very conservative balance sheet. So it didn't have much debt and then got this big infusion of cash from asset sales, but it's always got lots of positive working capital. Okay, so it's receivables, debtors, minus its creditors or payables, is a big number. To give you an idea, at the end of December 2017, it's about $38 million. Okay? Let's just put Cabcharge into context, okay? And we'll use our house analogy again. Cabcharge has just over 120 million shares on issue, and they trade around $2. Okay, so the equity market value of Cabcharge is $241 million. Okay, now let's just stop there for 1 minute. Okay, just stop there for 1 minute. You can buy the central player in Australia's taxi industry for $240 million. Does that make sense? Because it doesn't to me. It sounds way too low. Okay, when you see the valuations given to Uber, okay, which makes no money. Okay. So I just kept thinking in my brain, it just didn't make sense that I could buy this big player in the taxi industry, which is not going away just yet, for $240 million. Now, as at the 31st of December 2017, Cabcharge has $20 million of cash on the balance sheet, and it has $3.5 million of debt. So within that $241 million, there's actually $16 and a bit million of net cash. Okay? And there's also $38 million of net receivables, $63 million of receivables and $25 million of payables. Okay? So if you think about it, the value of the business actually isn't $241 million. It's $241 million minus $17 million of receivables minus of net cash, and then $38 million of, in my opinion, surplus working capital. Okay? So if you think about it, the value of the business is only somewhere in the order of $185 million by the time you do that bit of arithmetic. So I'll relate that to earnings in a minute. What Cabcharge have also done is they had a treasure trove of properties. They rationalised their property holdings, made sure they moved into the right places. Bear in mind, if you run a cab fleet, you do need a property. You've got to park a cab somewhere and somewhere and all that sort of stuff. Okay, but they sold a surplus property in Sydney money for that as well. Okay? So that's something else to look out for. If you see companies, there aren't very many these days, but in the 1960s and 70s, there were heaps with surplus properties on their balance sheet that were very undervalued on the balance sheet as well, which is why there were so many takeovers in that era and asset strips. Okay? So for my $185 million of Cabcharge, so remember that's the equity, minus, in our case, net cash, because they don't have net debt, minus surplus working capital, that gives $185 million or so. Okay? This company, okay, earns somewhere in the order now, having had its earnings eviscerated over the last few years, this company still earns somewhere in the order of $38 million a year of EBITDA, earnings before interest, tax, depreciation and amortisation. Okay? So divide 38 million into 185 million and express it as a percentage. Okay, if you think about it, you're earning basically a very, very high teens return on your money. Now, in addition to that, we all acknowledge that Cabcharge has got to reinvest in this business. Okay, so it's got to spend money on plant equipment. It's got to spend money on making sure it's got technology. So it's spent more money on that. So this has been a company where you didn't want it to spend less money on stuff. You wanted capital expenditure to happen. And it's ramped up its capital expenditure. So it spends about $10 million a year on capital expenditure these days. And it also expenses off a lot more money on building apps and things of that nature. So, what we end up with is a company that's making $38 million of pre-tax, pre-interest earnings. Does that tally up with the cash flow? How do you check that? Because there are so many companies that talk about EBITDA these days. And then you go analyse the cash flow statement and it's on a different planet to EBITDA. And I can assure you it's usually on a much smaller planet. Rarely on a bigger one. You can go to the Cabcharge accounts and you can look. And one thing I would suggest you do is you look at the top two lines of the cash flow statement. So in the case of Cabcharge, it's on page 6 of their interim results for the 6 months to 31 December 2017. Their receipts from customers were $631 million, and their payments to suppliers and others and employees were $612 million. So with a little bit of rounding, and that's why arithmetic's gone skew with, that's $19 million difference. Okay? And the good news is the EBITDA that they reported in that first 6 months was just a tiny bit less than 19 million. It was 18 and a bit. Nice. That's logical. Why? This company gets paid in cash. You don't pay for your cab ride 6 months later, you pay there and then with a credit card. Okay? So it gets paid in cash, but it's also paying out very, very quickly. This is not a Woolworths. Okay? That takes your cash here and now and pays its suppliers 67 days after the end of the month. 60 days after the end of the month in which the goods were delivered. So don't ever deliver goods to Woolworths and Coles on the second day of the month. Waiting a while for your money. Okay? So it's very logical. If you saw Cabcharge with a big discrepancy between EBITDA and the first 2 lines of its cash flow statement, there'd be a problem. You'd be wondering why, whether it was a positive one or a negative one. Because there's no logic in that. Whereas for the retailer, and lots of other businesses, you can play with working capital. Big retailers in Australia run massive negative working capital. The best example I can give to you is a company we've mentioned already today, Apple. Go have a look at Apple's negative working capital. Apple run off other people's money. Okay? They have a massive working capital deficit. Okay? Because their receivables minus creditors minus payables are huge. Massively negative. Because, of course, if you're a supplier to Apple You're in the same position as the Spider Wars. You beg, get on your knees and say yes, sir. Okay, when they want 5 more days to pay or whatever. Okay, so that's quite important. Apple's it's something like 22% of Apple's their negative working capital is equivalent to about 22% of sale. Wow, that's enormous. Okay, take it from me, that's gigantic. Yeah. Typically sales are as big as Apple's. Yeah. So that's one reason why Apple really is a capital management machine, being able to do that. So the great thing about Cabcharge is that the cash flow and the reported pre-tax, pre-interest profit lines up. So it's very cheap. They produce good amounts of free cash flow after they paid capital expenditure and everything else. So that the company basically can continue to accumulate cash, from its business at the current level of activity, And so it may be a slow growth company, but the company basically has got lots of opportunities to, in my opinion, buy back its own shares and continue to pay dividends to people as well as invest in the business. Okay, I've had a running debate with the board at the last 2 annual general meetings about why they don't buy their shares back and why they persist in paying high dividends. And the first sign, and it's a rarity, that the company slashed the dividend at the interim results this year. They used to pay 10 cents a share twice a year, so 20 cents a year. And the stock was $2 in fully franked dividends, tax advantage dividends. That sounds great, but all that was going on is that basically people were buying for the dividend, getting no growth. If you generate that much cash, you don't get any dividends. You start buying your own securities back if they yield 10% fully franked, because it's really expensive equity. Okay? It's extortionately expensive equity. You should be buying that equity back. It's expensive. Remember, if shares are cheap, the equity from the company's point of view is expensive, because if they want to use those shares to buy another company, they have to issue shares in an absurdly low price. So hence it's expensive to them. And I've been having a big debate with Cabcharge that they should start buying their own shares back.
How's the debate with the Cabcharge board going?
At the moment, not that great. They haven't bought any shares back, but I think, it's quite surprising that they have cut the dividend, as I said, and that is very rarely a positive sign in the company, but in this case, I think it is. They do certainly have more marketing and development spend, and so they do want to keep a bit of money back. They're inherently conservative. And so I think they're seeing how things go. What is a year of transition for them this year? They should start to, they're coming out of this path of having their fees cut off credit cards. So this is more or less the first full year at the lower level. We just want to do it. One other thing that's been great to see is actually there's been a lot of change on the board, and I think in the main it's been positive. The new chairman from the last annual meeting, Paul O'Neill, has a long track record at this called Amalgamated Holdings now and then. So he's a smart ex-executive, so he's a good chairman, and it's good to see the board have actually started to buy some shares as well. Because something infuriating against the annual meeting where the people on the board who had next to no skin in the game at all, particularly when, in my opinion, the shares are so cheap. So that's been good to see. So I think I made a small error actually earlier on, and the actual return of 185 million and making 38 million is over 20%. Wow. Effective cash flow return on the value of the business. Wow. So before depreciate, before what you have to put back in, what you invest in. So,
Do you have a pass-fail mark for that figure when you look at your company?
Yeah, absolutely. I want to see that number usually somewhere in the sort of, I want to see it in the teens, definitely. Okay, which means if you turn it round, it's what people would refer to as an EV/EBITDA multiple below 10. And depending on the nature of the business, if it's a slower growth business, I preferably want to see it in the 5s and 6s and 7s. To give you an idea, when we spoke about my entertainment group a year ago, that figure for them was about 5.
Yeah.
Okay. So it was really cheap and a very strong, guess what, cash flow driven business.
Yeah.
TV stations, well, they need cash flow. They might be in decline or not growing very quickly, but they need cash when it's still there.
It's interesting you talk about that ratio, and just going back to our conversation about Apple earlier.
Yeah.
Someone we've interviewed since we first interviewed you was Toby Carlisle, who uses that enterprise value to EBIT ratio,
Yes.
but has used it to recommend Apple recently.
Yeah, they're at about 10.
Yeah.
Okay, which depends on what you're sort of thinking about the prospects for their business. Okay, if you look at things like Amazon trading about 38 times the price value of operating cash flow, which I don't care how good Amazon is, when you've got a 38-year horizon, you've got to get a payback from. I think it's too long. So, it is a sensible ratio. Look, it's a ratio that grew up with the leveraged buyout movement in the United States in the 1980s, because they took that cash flow and obviously borrowed a lot of money against certain types of companies. And that works sometimes and it's a good other times.
Yeah. So, getting back to Cabcharge.
Yeah.
So, at this point, you found that the enterprise value to EBITDA ratio was good.
Yeah.
The inside the board has changed and it's started by the shares, so there's insiders that are obviously saying good things.
Yep.
You're pretty happy with the capital management of the business.
Yep.
Was there anything that you thought, oh, hold on, this might be a bit of a red flag, or?
In this particular situation, not really, okay? Because one of the things that you're looking for in any investment, in any thesis, and don't forget, this is a bit of a turnaround situation, okay? But even in a steady state investment, you've got to have a thesis about what you're looking for. You put it red flags, I'm going to call them green flags. What are you looking for? Is it this level of earnings? Is it a progression of earnings?
Yes.
Is it the use of cash flow to reinvest in the business or to distribute or buy back shares or what? Okay, there's a thesis about why you think this company is worth hanging on to, okay? And you want to see that thesis realised, okay? And so it's like anything, it's like there are milestones that you're looking for, whether they're levels of earnings or certain actions that the company might take to sell something or buy something or expand in a certain area, whatever they are, okay? And so in Cabcharge's case, they were generally remediative things, selling property, selling those assets that just didn't return and were non-core and then paying what bit of debt they had, etc. Whereas for, say, a growth company, you might be looking for them to introduce new products, okay, for those new products to do well. So you're continuing flags for, if we just use Apple, most obviously are new product launches, market expansion, price increases, etc., and lack of real competition, okay, or lack of competition having a real knockout product, that would really devalue Apple in a major way, in a way that other handset manufacturers in the past have been, sent out of business, like Nokia and BlackBerry and others. Okay, so in every situation, it's not so much the red flags, but it's the positive things. Now, of course, if you're not getting those, when the green flags turn red, okay, and that's where you start the thesis. You've got to keep questioning the thesis. Okay, now that doesn't mean every day. Okay, it may be obviously in the US because you get quarterly reports. You want to make sure the company's broadly on track to what you're thinking. But certainly in Australia, a couple of times a year you've got earnings reports. A bigger company may have an investor day. They have to post all the slides and commentary up of that. So you want to see things like that. A lot of these things are webcasts, so even if you're not able to ask a question, because you're not an institutional analyst, you can certainly listen to the questions and evaluate whether the company's not quite going the way you wanted it to.
Yeah. So can I just ask then, if as long as you're getting the green flags, there's nothing that would be a sort of
instant turn-off? Like insiders selling their shares or...
No, I don't. Look, sometimes insiders have to sell their shares if they're heavily committed, they have tax bills and things like that. I prefer not to see that.
Yeah.
I'm like anybody, you want to see, and it's great if you see the management really stretching themselves to buy shares. I love seeing that, and certainly, nobody doesn't. I should point out, some of the recent spectacular failures in Australia, management bought shares immediately before that. Sky, for example, Bigger, I think they did as well. So that's not always, it's not always, the thing that you expect. You've got to look at it on a case-by-case basis.
Yeah.
But, the main flags are just really that, the business is not running the way you thought it was going to run, that, management basically have taken their eye off the ball, and you sometimes only get to know that when it's happened. You sometimes, obviously, if you're a full-time analyst, if you cover competing companies in a sector, then you pick that up very early. And often analysts speak to companies that are unlisted that are in that particular sector, and they often give you clues that the listed companies are cutting prices or having problems here or there.
Yeah.
So you come up with your thesis and then you look for your green flags.
Yeah.
My question is, do you have, say for example, price to earnings, earnings per share growth, these sorts of things?
Yep.
Without the experience that you have to get an idea of what they are relative in the industry, do you have like a benchmark for each?
Absolutely.
If we were to look at it and go, earnings per share growth 5% a year, not even worth it, for example, or 2% a year, or
5% a year earnings per share growth.
you know what I mean.
It's positively spectacular. To give you an idea, just to put that in context, it's a great intro. Put it in context, since pre the GFC, so since 2007, earnings per share for the Australian market in its entirety, they're actually lower now than they were then.
Oh, wow.
So you wonder why the ASX S&P 200 is still nowhere close to 68.50, which is what it peaked out at in November 2007. And I thought this logical reason is earnings are below where they were there for the entire market. And you start to look at you think, well, that can't possibly be the case. Or start looking at Telstra and a few other things, and you get the idea pretty quickly. And all those financial companies that disappeared in the GFC, bank, brands and cards and whatever. So EPS growth of 5% in the current context is not as bad as you think, but you do have to obviously relate it to how much you're paying for it. So a lot of people use something called a PEG ratio, which is a price to growth ratio. So if you were paying, so basically if you were paying a 20 times PE for a 5% growing company, you've got a PEG ratio of 4. That's pretty expensive, okay? Whereas on the other hand, if you think about the reverse to use extremes, and you had a PE of 5, price to earnings ratio of 5 for a company growing at 20%, you have a PEG ratio of 0.25, which would be absolutely cheap, okay? People tend to look, if they use PEG ratios, they look for PEG ratios greater than 1. Okay, so you're quite happy to pay. PEG ratios below 1 is the way I've characterised it. So you're quite happy to pay a price earnings ratio of 15 for a company that's growing at 20%.
Yeah.
Okay, and things like that. I use enterprise value EBITDA a lot because some of the people don't like it. I use it a lot because I really think companies are just one business. Even quite simple companies are made up of, in my opinion, multitudes of other little businesses. There might be a key business that you think is the reason you're invested, but usually there's some other bits and bobs they have as well. Okay, so you take a company like Perpetual. Most people think Perpetual's a fund manager. Well, it is. And that's certainly why most people have owned the shares over the last few years. But it's also a very big trustee company. And it's also now got a private wealth management distribution business. where it sort of manages other people's, not their money in an investment sense, but it's like a financial planner. Okay, and then our meaningful businesses. And the way you value each of those businesses is quite different.
Why wouldn't the enterprise value to EBITDA work for just a single business?
It will. It will for a single business. But if you think about something like, something like a perpetual, you would probably use three different in fact, I do use three different valuation metrics to value each of those businesses, add them up, deduct a cost for the corporate headquarters, take off the debt, and come up with a figure.
Okay.
And so it would be the same if there are differential little businesses, within the other company.
Okay.
But EBITDA on a single business, I think it's reasonable, and you do equate it back. One of the things I like about EBITDA, okay, is it really cements this idea that shares are not bits of paper to be traded and thrown around. You are buying a claim on a small part of a business. Okay? And if I said to you, I want you to buy this entire business, you are first of all going to look at, so for everything else, you're going to look at the amount of cash the business generates relative to the amount you're going to pay for it. Okay? And that takes away the financial structure of the business, whether there's a lot of debt or very little debt.
Okay, so at this point in the process, you have done your due diligence, you've confirmed your thesis, you've seen some green flags, you're feeling confident that this is a company that you want to invest in. What is the process before you hit buy? Are you trying to quantify it down to a price, or are you getting into a range?
There's two ways to look at it for me. The first is to say, I think Cabcharge is worth X dollars a share. Okay? That's quite difficult, okay, because there are no comparatives. There are no peer group companies where you can say, hey, its competitor trades on an EBITDA multiple of 10. These guys are on 6 or 5, okay? And so what I do is I tend to turn it the other way around and say, at the current share price, my effective cash flow return on investment is, and as we've discussed, it's about 20%. And that's outrageous. Okay? Unless it's going to go down the toilet very quickly. Okay? And so I tend to look at Cabcharge that way rather than drive it to a share price. Many other companies I drive to a share price by using analysis of their cohort. So bank shares, there's heaps of bank shares around the world, so you can do all sorts of analysis on that. Insurance companies, the same thing, etc. Obviously, companies that are asset-based, property companies or companies that just have portfolios of shares, you can actually drive them to a value and say, if these guys got smart, liquidated, the stock's worth $2, I'm buying it for $1.50, there's 33% upside. So I do both.
And so I guess you could reverse engineer it as well and say that if this is the price now and this is a cash flow investment, you weren't happy with that.
Correct.
So you could then work out an entry price.
Absolutely.
By figuring out what you were happy with and what price that would be.
Absolutely. In the case of Cabcharge, I also, which is outside the scope of tonight, but I build financial models, to make sure that when the earnings do come out, are they kind of approximating what I think? Okay. I build those models up, and those models help me with the value as well. With Cabcharge, even if you thought Cabcharge was a very, very low growth investment, you could sort of assume the kind of cash flows for Cabcharge out well into the future, which I think is fraught with risk. But you can come up with a net present value of those cash flows, and hence obviously a share price, a hard number. But I think in the case of Cabcharge, because of all the change in the industry, I'm not that confident to do that.
Okay, so then once you've hit trade, it's in your portfolio. I guess the question is then, if Cabcharge, we've already touched on how often you sort of check it and you confirm your thesis. But then, if Cabcharge goes up in value, how do you know when it's time to sell? Do you use stop losses and stuff like that?
No, not at all. In the case of Cabcharge, this one has gone down in value, so it's a case of particularly on something like this as well. I mean, it's good. I mean, you don't use all your firepower in one go. You know, so if your unit investment's $20,000, let's say, you don't put all 20 grand in. It's really best to, put part of it in and then just wait a little bit and see if the thing's tracking the way you want, because you'll never pick the share price at the bottom. Okay? Likewise, you'll never sell at the top. So that it's best I often what I call leg into a thing. So I might spend time buying the stock over a period of time, say 6 months.
Wow.
Okay.
And that's your approach across the board?
Unless I see a very, very specific opportunity. I've seen a very, very specific opportunity in the last 2 days. I might book an entire unit in 3 days.
Right.
Okay. Which I'm not disclosing.
That's fair enough.
But generally that's my approach, and that's been a very good approach for Cabcharge, because the shares are traded like bear in mind there's no dividend adjusted, but it's sort of, effectively about $3.20 dividend adjusted from the $4 minus 80 cents of dividend, down to $1.60. So it's been quite a wide range. Okay, and so I tend to buy them and they've been really hammered, knocked around, and figuring that things are progressing broadly the way I thought.
Yeah.
So far in Cabcharge, I've bought 3 lots of stock about a few months apart.
Okay.
And for our listeners, that's the concept that we talk about, dollar
cost averaging. Absolutely. Yeah. Dollar cost averaging is obviously when you just commit a set amount of money, usually to a stock like an index or a fund. Usually like a small monthly amount or maybe a larger quarterly amount. But you can do that on individual stocks as well. So that if you want to see how things play out, rather than putting all your money in one go, you put a little bit in each stock.
Pending brokerage fee.
Yeah. The good news is brokerage fees are coming down.
Yeah, that's
line is $20. So easy. So.
And then, do you define in terms of time or in terms of any rules when you enter, or is it just
time? The one thing I'd really get people to understand is time is not that relevant. Okay, you can't dictate what the stock market's going to do time-wise. Okay, now let's just surmise I thought Cabcharge was worth $4 a share. Okay, I don't. Okay. And that's not a number, it's just I'm just using it as a hypothetical. We don't know. So if Cabcharge is $2, I don't know when it's going to go to $4. It might go to $4 tomorrow morning, so it might be a takeover. Okay? It might take a few years to go to $4. Now, quite clearly, I'm cognizant of the time value of money. Okay? But I can't dictate when it gets there.
Yeah.
Okay? Just another thing, why don't I use stop losses? Okay, what's the point? Because surely, if I'm buying Cabcharge at $2, because I think it's worth more than $2, it's very attractive. If it gets to $1.60, you want to buy more.
Yeah.
You don't want to sell it at $1.60. You want to buy more. Okay.
What about on the flip side? If you have a stock that's run, but you don't want to cut your losses, you don't want to cut your wins short.
Yeah.
Would you want to trade it else?
No, you don't. To me, it's just a case of you keep evaluating, and then if the shares have reached a level that you think is now too expensive, given the nature of the business, okay, then obviously you start making a decision to trim your holding back and potentially exit. Okay, I mean the stocks. You will often hear stocks referred to as compounders. Okay, they're companies that earn large returns on equity and hence can compound a reasonable level of earnings growth well into the future, and they're usually the kind of stocks you don't sell, because they've got a very good business that enables them to do that. And a lot of people will tell you, even if they get a bit expensive, they don't worry about it. They don't sell them and try and buy them back, because usually when they do, all of a sudden there's a really good quarter of earnings or something, and they skyrocket past where they were before.
Yeah.
So they're the kind of stocks you just hold on to and everything else. Cabcharge is not one of those.
Yeah.
Well, that brings us to the end of your process.
Yeah.
Wow. Very insightful, yes, and some great introduction to some concepts that we haven't touched in detail. But as you said, Ren, we'll the analogy of the house up in our blog so that our listeners can go back. I think just with the interest of time, there's 9 questions that we went through.
Yes.
We're not going to ask methodology.
There's a lot of easy yes and no.
I think, we could do some yes and no's just to see if Cabcharge fits the bill.
Okay.
So I think we can do. So question 1, and for the listeners that aren't aware of what we're doing, we discussed this in previous episodes, so definitely go back. But question 1, does the business have an identifiable consumer monopoly?
No.
Okay, so that's a no.
It has an identifiable monopoly, or not monopoly, but oligopoly. Not a monopoly. It has an oligopoly, obviously, in the provision of personal transport services and also the charging for those services as well.
Okay.
So it's not a monopoly, but it's certainly an oligopoly.
Okay. Number 2, are the earnings of the company strong and showing an upward trend?
No. They're strong but not showing an upward trend.
So number 3, is the company conservatively financed?
Absolutely. Far too conservatively financed.
That's a big yes.
Yeah.
Number 4, does the business consistently earn a high rate of return on shareholders' equity?
Yes, it actually does. Even on its lower, even on its lower earnings, yes, it does.
So does the business get to retain its earnings?
Yes, absolutely it does. Okay, because it's earnings minus capital expenditure, minus tax, minus, there's no interest payments, so then no Cabcharge is a positive number.
Yeah. How much does the business spend on maintaining current operations?
About $10 million a year of capital expenditure.
Okay. So is the company free to invest retained earnings in new business opportunities, expansion of operations, or share repurchases?
Yes, it is.
And how good a job does management do at this?
Somewhere between appalling and disgraceful.
I thought you liked the management.
I do. I like the management. The job of all that is not the management. It's actually the board. The board, dictate dividends and capital policy.
Yeah.
I mean, it's obviously up to management to bring ideas to the board, but that is a board decision. The management's operational management, I think, is very, very good.
Yeah.
I think their strategy is excellent as well. But the capital management of the company to date, I think, has been poor, and I think can improve significantly. And I just keep banging my drum. So.
Okay, so question 8, is the company free to adjust prices to inflation?
No, it's not, because the environment's too competitive in one area and it's regulated in another area, so not really, no.
Yeah, and then the last question, will the value added by retained earnings increase the market value of the company?
It should, and it's currently not. Okay, and it should, because basically the market value of the company should be increased by retiring expensive capital, which in this company's case is equity. Okay, so over time, if they adjust their capital management policies, then I hope to be able, at a future date, be able to say categorically yes.
Yeah.
Okay, so in the case of Cabcharge, the sort of buffertology checklist. We fail on certain things.
Yeah.
So it's not the only bridge into town or a monopoly like that, but it does have good returns on capital, and it just needs to use the free cash flow that comes from those returns, in my opinion, in a slightly better way.
Mm. And we should say that this checklist was more geared towards the compounding companies that you were talking about earlier.
Absolutely.
That you just buy and hold for, the Coca-Colas and the Seas candies and all of them.
Coca-Cola is not a compounding company.
Well, it was when he bought it in the 70s.
Newspapers were at that time.
Yeah.
Compounding companies in Australia tend to be infrastructure things, roads, airports, that sort of stuff, but obviously there's a question mark about just how expensive they are.
Yeah. So that brings us to the end of the interview. I did want to ask one question before we go, because I really enjoyed your Uber due diligence example of driving Uber for 3 months. So I wanted to ask, do you have any other good due diligence stories of things that you've done that are out of left field to do your due diligence before buying?
Flew a 747.
Yeah.
Didn't fly a 747. I've often done things like... I found companies that have got what I think are surplus properties and surplus assets. So rather than speak to management about it, I just get in the car and drive to funny places and go actually look at the things. what are they? I then do, you can do land title searches. I use, which is a serious bone of contention, I do a lot of, I use the ASIC database quite a bit, and the bone of contention is the fact that in the UK it's free or a pound, in New Zealand it's free, and a company search in Australia is $19.
Oh, wow.
It's absolutely the most egregious rip-off. It's terrible. We've done that. I mean, we've done searches on subsidiaries and things like that to check out, what they earn, how they're financed, which don't come out in the consolidated accounts of the company, where all the subsidiaries are just meshed in together. So I've done a lot of stuff like that. So things like that. Not so much left field things like driving Uber. I haven't worked in Macca's or anything like that. That's the most the most obvious thing is you go to visit things. It's the Peter Lynch theory, if you will, from his two brilliant books written in the 80s, one up on Wall Street and Beats in the Street. Which is all about if you're a consumer, you usually understand the company a little bit better. Certainly, if you work in a company, you understand it better again. So, you can certainly understand how a retailer works. If you work there part-time on a Saturday or something like that. So, but then it's things like I do a lot of searches, and spend real money doing that out. And probably one of my best investments, so 3 times our money in about 7 months, was done on the back of searching out an associate of a listed company and realising that we were buying the things so cheaply. It was ridiculous. That was a company called National Hire Group, which was controlled by Kerry Stokes, it owned at the time 46% of Coates Hire, which wasn't listed. So we did all the searches for Coates Hire, built a model on that, realised how much that was worth, plugged that back into National Hire, and came up with a value we could barely believe.
Wow.
And we got lucky. It goes back to the issue of time. I didn't know how long that was going to take, and I was prepared to be very patient, as you would imagine. As it turned out, paid off in a few months.
That's great.
Which is, that was pure luck.
Yeah.
Paid off in a few months, but to do the homework to find it was very pleasurable.
Yeah.
Well, it's been a pleasure, Andrew, as always.
My pleasure.
As Ren started with, first gets to be back on the show.
Yeah, absolutely. It was thoroughly enjoyable. I enjoy talking about investment, as you know, and I hope people continue to listen to these kind of podcasts because they're it's a great way to get to learn, and hopefully there's some practical advice in how we pull a few things to bits, and also I have some advice about being humble because everything you look at is not going to work out.
Yes.
As you've seen, and fess up to that. And understand your mistakes. I think what's critical is if you do make a mistake, understand why you made it, go back, write it up, keep a record of it as to why you made the mistake, where it went wrong, and so you don't repeat that mistake again in the future. That's important. But thanks for having me. Loved it.
Thank you.
Before we go, if our listeners want to follow you on Twitter or in social media or anything, do you have a...
First of all, my company is called E72 Holdings, and we have a website, www.e72.com.au. Part of that is investment reports, and I write a quarterly each quarter.
Yeah, which is great. I really enjoy it.
Which is usually about 10 to 15 pages. Sometimes it's just about markets, but usually I usually have a bit of. I usually do a couple of companies that we have an investment in. For example, in the March quarter, we looked at Gowing Brothers Limited, which is very interesting, and we own it, and we actually looked at McGrath as well, and compared McGrath to a listed estate agent in the UK. And also on there are some investment presentations that I've given. So I've given one very, very recently, and there's a link to that as well, which covers off on some of the holdings we have, and we look at a couple of other companies in detail. Allied Cotton Limited and a US listed oil tanker owner called DHT Holdings, plus some other stuff on there. So there's quite a lot of ideas in that. There's 30 odd pages of it. And then if you want to get in touch with me on social media, I'm at Aberon Investor, ABRONINVESTOR on Twitter. And you'll get
following.
And you'll get a little bit of politics and also you'll be kept up to date on the performance of Scunthorpe United as League One.
Well, I guess we'll leave it at that.
Brilliant. Thanks, guys. Thank you.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates.